past quarter was positive across the board, with most major markets again providing solid returns. Asian and emerging stock markets led the way, with China's local market jumping over 20% in September, thanks to the promise of government stimulus and direct stock purchases boosting confidence to get the country out of its economic slump. It won't be that easy, of course, and there are expectations of further stimulus measures to come. The UK has ticked along quietly, with the FTSE All-Share returning 2.2%, making 13% over 12 months. The US slowed its relative performance, giving a small negative return from the S&P 500 in pound terms, but has still delivered way above expectations of 23% over the past year. The fixed interest market was buoyed as central banks finally started the downward leg of the interest rate cycle, kicked off by the European Central Bank. Interest rates in the UK now stand at 5%, in Europe 4%, and in the US within a range of 4.75% to 5%. The UK is of course on tenterhooks ahead of the budget on the 30th of October, as the nation prepares to hear where the pain of tax increases will fall. The Bank of England is being more cautious than other central banks about lowering interest rates given the uncertainty of government policy and the potential impact on economic growth and inflation, even though the latter fell below the 2% target, a 1% annualised growth in September, thanks to falling fuel prices. This has meant that the pound has remained relatively strong of late. The bank cut rates to 5% in August, held in September, and is widely expected to cut again in November, all subject to the budget announcements. In recent interviews whilst attending IMF meetings, the Chancellor Rachel Reeves confirmed she will adjust the public debt rules to allow for more investment, which is something we've commented on earlier this year as probable. Markets have caught wind of this and the gilt market doesn't like it, with the 10-year yield rising to 4.2%, having been around 3.7% last month. The market is reinforcing the Bank of England's cautious stance. Remember the 5th of November, because that's the night of the US election. The Trump v Harris race is tight, and according to a New York Times poll, the candidates appear essentially tied. The policies of whoever wins the race, however, do little to address the 6% annual overspend of the US government compared to GDP, as it will either be tax cuts under Trump or more spending under Harris. The stock market should generally respond positively to a Trump win given lower taxes and regulation, and perhaps would be more sanguine if Harris wins. It's going to be a fascinating few weeks for investors, and we hope for low market volatility in response to the events. But nonetheless, we look forward to reporting further.